So these are conversations that Wealth Legacy Institute has been having with their clients for the last several weeks, and I wanted to make sure that we shared them with you. So the very first thing is what a year it has been as it relates to the capital markets and the volatility, with the Federal Reserve doing 4 75 basis rate hikes for the Fed funds rate, which has set chaos into the capital markets, particularly fixed income funds, because when the price of bonds go up, the value goes down. So it's like a seesaw. And so this is one of the first times in a very, very, very long time that we have the opportunity, first strategy, to tax loss harvest. And usually that's done with equities, but this time we have the opportunity to tax loss harvest on fixed income as well. And basically what that means is when investments go down, you can sell them and capture that loss and offset it by capital gains either in that year or years into the future. And if you don't have capital gains, you could take up to $3,000 a year loss on your income tax return until that capital loss harvesting is empty. But it's such a great time to harvest because there's a lot of gains in equities that we've had over the years, so that if you can harvest those losses in fixed income, maybe next year or the year after, when you rebalance those portfolios in the equity position, you actually can offset that with the loss and not have to pay capital gains. Wonderful, big strategy, big conversations that we're having this year around tax loss harvesting. The second is maximizing your 401k. Pull out your pay stub, see how much you've contributed year to date, and if you can get to the maximum contribution limit, which for 2022 is $20,200. So $20,200, maximizing your 401k, and if you happen to be over age 50, you can contribute another $6,500 for the year. But going into 2023, big increase because of inflation. So for 2023, make sure you get it all set up in the beginning of the year with your payroll department to contribute up to contribution limit of $22,500. And again, over age 50 is $7,500 for a total 401k contribution limit, $30,000. Excellent strategy. And then let's talk about number 3. I love this strategy for those of you who have health insurance, high deductible healthcare plans. Health savings accounts offer more tax benefits, believe it or not, than your 401k. It's a better deal because you get triple tax-free benefits. Triple tax-free benefits, and here's why. Because when the funds go in, they're tax-free. They grow inside the investments tax-free. And when you use a qualified withdrawal, which is basically used for medical expenses, it's tax-free. So here's the key. If you have a health savings account, make sure you have individual mutual funds inside of it instead of just using a cash account. Here's the other tip. Don't use your health savings account each year. Let it grow, and look at it as something that you use in like your 80s, like when you're 80 years old when you really need it. So that's one of the strategies for health savings accounts, is not use it to spend the next year, but to use it to grow long-term so that you have it as an offset for some long-term care needs. All right, strategy 4, consider a Roth conversion if you can. So think about it, the capital markets are down. It's a perfect year if you have the ability to convert some traditional IRA to a Roth IRA in a down market, and then when it's in your traditional IRA, it can grow, into the Roth, it can grow tax-free. And it does not have the required minimum distribution requirement that now is at age 72. So the younger you are, the more advantageous it is to do a Roth conversion, but also remember you have to pay ordinary income on those benefits that you convert from the traditional IRA to the Roth. But it's a good year to have that conversation with capital markets being down to move that money over at a lower dollar amount. And then lastly, optimize your charitable giving. If you're over age 70 and a half and you are required, or you have required minimum distributions, or wait till 72, depending on where you are when that law changed a few years ago, is do a qualified charitable distribution. Instead of writing a check to the charity out of your checking account, write a check to the charity out of your IRA and make that a qualified charitable distribution, and you have access up to $100,000 a year. And if there's a couple, that's a total of $200,000 a year that you can donate tax-free to you using your traditional IRA, and oftentimes your required minimum distribution amount if you don't need that for your living expense. So those are 5 strategies that are super, super helpful that you could really make a huge difference on what your 2022 tax looks like, and be prepared going into 2023 for your HSA contribution amount and your 401k contribution amount. I hope this is really helpful. If it is, please like and share it with others, and thank you for your time.